travel isn't just about destinations, it's about the people you meet, the cultures you immerse yourself in, the stories you carry home. I'm Relebogile Mabocha, and on my travel feature, I take you on a journey beyond the guidebook. Each week, I connect with fellow travelers, insiders, and storytellers to bring you the heart of every place. Whether it's a hidden gem right here in South Africa or a dream destination abroad. Join me as we travel through conversations, memories, and inspiration. Listen wherever you get your podcasts.
The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram is a certified financial planner at Galileo Capital. Warren, good evening. You want to talk tonight about why you should not reduce the risk of your investments when you get older. And I have to say, it had me scratching my head a little bit. I find as I get older, I drive in a much safer way. I live a slightly safer life. I like to take less risk. You're suggesting we shouldn't do that as we get closer to retirement.
Well. I think you should probably drive a bit slower and be a bit safer on the roads. Our reflexes are not as good as when we were younger. So with investments, the difficulty is that we want to manage risk. We want to avoid risk sometimes as we get older, and we would love a bit more certainty. We live in such an uncertain world. Right now, it seems to be on steroids, the uncertainty, but the concern I have is that when you buy certainty with your investments, you could be doing that at an enormous cost, and very often the temptation to say, I'd like a bit of certainty, I'd like a bit less risk, seems intuitively correct, and certainly on a human level, I understand it. But unfortunately, that uncertainty and potentially the volatility of investments, the rocky road that they give us, could be the very thing that helps get us to a comfortable retirement. And the certainty could be the thing that actually derails us and leads us to a very uncomfortable retirement.
Okay, so there's a difference between risk and volatility. And sometimes these things can look the same. Why are they very different?
So let's talk about volatility. And I know it's jargon, and we try to do our best to avoid that. But when you look at an investment that is nice and stable and predictable, I think the two best examples I can think of would be a fixed deposit at the bank, or an RSA, retail savings bond from government, where you know exactly what you're getting. They're going to guarantee you interest rate of 10% a year for the next 5 years, or whatever it is, 10.5% per year for the next 3 years. And on a human level, that's almost designed for us. That's catnip. And the reason is because it gives us all the certainty we could possibly want. We know that we're going to put our money in 3 or 5 years' time, whatever the term is, we're going to get that money back. And every year, we're going to get paid our 10 or 10.5 or whatever percent interest. Everything is known, and we feel great. The problem is that when you look at interest rates and the certainty they provide, and you measure those interest rates that you're going to be earning, the interest that you're going to be paid, and you track it against the cost of living, and you see how the cost of living rises over time, it's no coincidence that cost of living seems to track the interest that we earn on our cash. So if you're earning around 10% on a fixed deposit, guess what? The cost of living is probably doing the same amount of growth against you. In other words, your money is losing value by about the same amount. So the certainty that you're getting from a very stable, very predictable, basically zero volatility investment is locking in absolute certainty that you're not going to be able to beat the rising cost of living. And the simple reason is that you might earn 10%, and that might feel really good to you, especially if the cost of living is only 6 or 7, but you're forgetting that you're going to pay tax on that interest. And so something which has never lost you a cent from one day to the next, if you only store your money in a bank account or a fixed deposit or a money market account, and you look at your buying power of that money in 10 or 20 years' time, unfortunately, the power of your money will have eroded substantially. So that's a zero volatility investment. That's an investment that gives you absolute stability. It's locked in. the worst possible outcome for you. If you contrast that with something that we can all access, which would be the South African stock market or the global stock market, and you can do that very simply. You can buy an index tracking, exchange traded fund, or an index tracking unit trust, or just a general equity unit trust and a global equity unit trust. You would be in the stock market. It doesn't take a real genius just to buy it. I mean, there's no specialist knowledge required there. The difficulty with an investment like that is it moves up and down in huge waves. And sometimes, you could look at your statement today and it'll be up, 100,000 if you put in R1 million and you'd feel, really clever and really happy with life. 3 months later, you look at your investment and it's down 100,000 rand, and you feel terrible. And that is the definition of volatility. If you had to put that on a piece of paper, it would look like the saw blades or like a roller coaster. It's just going up and down all the time. And as human beings, that's the one thing we're not programmed for. We don't like that volatility. We don't like the instability of stock markets. We crave certainty. However, you look at the stock market over a 20 or 30-year period, whether it's in South Africa or overseas, and stock markets tend to grow at about 5% a year faster than the cost of living. So you get no stability, you get no certainty every single day, but what you get is enormous protection against the cost of living increases. So on the one hand, go for stability and lock in a certain rate of return on a money market, also locking in the certainty that you're not going to beat the cost of living rises, or embrace volatility, which is what it is, and understand that you're protecting yourself against the real risk, which is the rising cost of living. And unfortunately, you and I are not going to do a show next week to say, listen, Joseph, your cost of living has just changed by 0.2% this week. That's not newsworthy. It's not a big event. It happens day after day, week after week, month after month. It's like a slow poison, and no one's shouting at you to alert you to the problem until it's too late. So volatility, I think we need to be comfortable with it, and certainty, we should actually be a little bit more wary than we would have been in the past.
A big part of this, of course, is how old and how long do we think we're funding for? And obviously we find that people are living longer now. If you go for a physical and you're middle-aged, often the first question from the doctor is, are your parents still alive?
And 40 or 50 years ago, a 50-year-old would have answered the doctor and said, no, they're not, they died a while ago. But nowadays, a 50-year-old will very comfortably expect to live for 30 to 40 years. There are, a large number of people in their 80s and a smaller number, but a rapidly increasing number of people who are getting to their 90s. And, people at 21, who are 21 today, they should expect comfortably to live to an age of 100. That would not be unrealistic. And so if you're looking at that and you're saying to yourself, I'm 50 today, I plan to retire when I'm 65, you need to say to yourself, that means that at the age of 50, if I keep reducing the volatility of my investment, so I keep embracing certainty, and I get to the age of 65 and I want no uncertainty. I want everything locked away in fixed deposits or cash or money market accounts because I'm about to retire and I can't afford to lose anything. What you've done is you've limited the buying power of your money for life. In other words, you're not going to get that volatility which is unsettling, but also gives you the inflation protection. So we need to say to ourselves, at age 65, surely we shouldn't be reducing the risk right down. We should be moderating the risk. That's not a bad idea. But that means you don't invest like a 21-year-old. You don't have 100% of your money in shares, cryptocurrencies, and your favorite horse at the horse races. But you should have a very high exposure to the stock markets, and you should aim to retain that exposure for the remainder of your life. It shouldn't be going down, which would have been conventional wisdom, 20 or 30 years ago.
If you have more money, can you then have more volatility?
So this is the great unfairness of life is those of us, there will be lots of us that will get close to retirement and realize we don't quite have enough. We might be forced to take a package from our employer and, at age 65 and realize that, the money's just not going to be enough for our lifetime. And so the temptation then would be to increase the amount of risk we take, increase that volatility, so that we give ourselves the best chance of growing our money a bit faster than we would have done in the past, to try and make up for the reduced amount of capital we've got. If we don't have enough, the temptation is, well, let me scale up my risk so that I actually try to make up for lost time and get that capital back, even if I can't afford it. The difficulty with that is when you retire and you don't have enough money, and then the stock market goes down, you're drawing from your investments. And if you've got 75% in shares, which is what a lot of balanced funds have, and balanced funds are the core vehicle for all retirement funds, then you might be in a position where your investment has gone down 25% in a really bad crash, and you're drawing on it, let's say at 5 or 6 or 7% a year, which means you're eroding the value of that money very significantly. You might actually be in a position where you cause a permanent loss of capital to yourself. And so, you need to know that if you're compromised financially as you hit retirement, you actually need to be a little bit more conservative. You can't afford to be drawing on your money and having big stock market moves that force you to sell assets at a huge discount. The other side of that coin is, if you've got enough money and maybe you've got a bit of excess and you're going to leave some behind to the next generation, you're in a position where you can afford that volatility, because you might not be drawing 6 or 7 or 8% from your capital. You might only be drawing 2.5% a year. And that means you can actually allow your capital to grow and still draw from it without too much concern that you're causing an erosion of capital. So unfortunately, in this kind of a situation, the more money you have, the more risk you can take, which means you give yourself a chance of actually growing your capital even faster. Whereas the very people who need that capital growth can't afford to take the risk, because they might just be in a position of even more losses in a 2 or 3 year period where markets hurt you.
When you talk about risk and volatility, does that mean you need to think about the overseas market option very carefully too, about where you actually invest? And I can hear your voice in my head: diversify.
I'm brainwashing you, Stephen. So I think it's true. We need to spread the risks of our investments as far and as wide as possible. So risk management for me is proper diversification. It's not avoiding volatility. You need to understand the concept of embracing volatility, but that doesn't mean you take all of your money and you put it into one share, which then might triple your money or take it to zero. That's not embracing volatility. That's just taking the risk through the roof. So if you're looking at the stock market as a place to give you good inflation protection, then the one thing you need to understand is that you don't know which stock market is going to do well over the next 5 or 10 or 15 years. And that means you should embrace having some in South Africa, in the South African stock market, and a significant portion in global stock markets as well. And that means that you'll be exposed to countries where things might be going very well and their stock market's doing particularly well, and equally that you'll be invested in countries where things are going tough for them. And if we look at it where we are right now, who would have thought that the German market would be going well when there's a potential that they'll be dealing with tariffs, and Japan's going well even though they've got an aging population, and so there will be so many factors that will move your money in a direction. But having significant diversification means you don't need to worry too much, provided those eggs are spread across many different baskets. And so I think, again, if you're in a position getting closer to retirement, make sure that, your range of overseas investments at the least is probably around that 45% level in international investments, and at the maximum probably closer to 75%. I'm saying probably because all of us are different. All of our positions will be slightly different from one person to the next. But if I look at the numbers and do kind of scenario planning, we should be aiming to have that as a range, 45 to 75% offshore.
We're speaking to Warren Ingram, the certified financial planner at Galileo Capital, and we have a question from Katlego for you, Warren, saying, my employer is forcing me to take life and disability insurance through the company retirement fund. I'm unhappy because I want to buy my own insurance to get more loyalty points. What can I do? Katlego, we'll have an answer for you in a moment.
The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, of course, the certified financial planner at Galileo Capital. Katlego's question for you, Warren. My employer is forcing me to take life and disability insurance through the company retirement fund. I want to buy my own insurance to get more loyalty points. This happens, I think, quite often. You move to a new company and they say you have to do this.
I think Katlego should probably be happy about it, Stephen. If I look at the price of insuring my life on my own, in other words, I go and buy my own insurance from an insurance company, and I do the diligent thing, which is I go and get a bunch of quotes from different companies. I tell them all my information. I negotiate hard. And I look at the premium that I'll pay relative to what I would get from an employer fund for exactly the same rand amount of cover. So let's just say I want to buy 5 million rands worth of insurance. 5 million rands of insurance through an employer fund is way cheaper and by many rands cheaper than doing it in your individual capacity. And the reason for that is the base of people that work at the company. In other words, it's not just me that the insurance company is looking at when they decide to charge a premium. When an insurance company looks at an employer fund, there will be a bunch of people that they will look at from young to old. And the idea there is that, the older people, are perceived to be higher risk and closer to death. The younger people, they might drive mad, they might be a little bit more reckless on the car, but at the same time, they're likely to live a lot longer. And so that spread of age in a pool of people at a company means that insurance company will look at that and say, this is a better subsidized pool of people. There's a nice discrepancy in ages, which means, we're not going to be paying out to underwrite a death, for every employee in the next 5 years. It's likely to be over long periods of time. So insurance companies will charge you a lot less for an employer fund than they will for an individual person. And that's particularly tricky if you think that there is a chance you might have some kind of a chronic illness in your family history. Obviously not now while you're busy trying to get the insurance. You need to disclose everything. But if you think that in your family history there might be some kind of severe illness, then being part of an employer fund will help you mitigate those kinds of costs. So I think and that's probably even more true for disability insurance. I think disability is, a very important form of insurance, but it's monumentally expensive when we try and do it, individually. And so getting it through an employer, I think Katlego should be, very grateful that that's being forced on them. And maybe just to jump on my soapbox for a second, I don't think you choose insurance based on loyalty points. I just think you're missing the wood for the trees when you make a decision like that. You choose insurance because the premium is good, they're going to pay out when they need to, and they are treating you fairly. That's really key. Everything else is just icing on the cake. But what you want to know is, if you've lost your life, you want to know that your loved ones are going to be looked after, or if you've lost the ability to earn an income, that you're going to be paid out. Loyalty points is not, that's a distraction. That's not why you buy insurance.
It's not the main thing. For all of these things, it's all about time, right? And that's your biggest ally in this. And that's where you've got to manage the volatility and the risk.
Exactly right. So if you've got a long time to live, I see a lot of articles saying that retirees should be really concerned because they might have a long lifespan. Well, I think that's a terrible way of looking at life. If you've retired at 65 and you've got another 30 years of life, that's a reward. Like that's something you should look forward to. And it's the same when you look at your investments. If you've got a 30 to 50 year investment span, that means you can embrace some volatility. You can allow your money to stay in markets without kind of creating an artificial deadline. If you're 50 and you're saying to yourself, I might live to age 90 or 100, you don't need to worry about 65 as a cutoff period. What you need to say is, I might be investing for 50 years. I can afford the risk and the volatility of markets. What I can't afford is the certainty of cash and money market accounts, which is going to destroy the buying power of my money.
And I mean, obviously, what you need to do very carefully is you need to just make sure you're also on top of things. So you need to actually make sure that you understand where you are and then not panic about it.
Yeah, and understanding that your investment statements are sometimes going to look a little scary, and any high quality investment, if you've got a spread of cash, bonds, property, and shares, you're going to look at your statement somewhere along the line, and it's going to be down, and that's okay. If you've got a good spread in South Africa and globally, it's going to go up or down, but over long periods of time, it's going to be very rewarding if you stay invested.
Warren Ingram, thanks very much indeed. Co-founder at Galileo Capital and, of course, a certified financial planner on personal finance this evening.